Jay, hello, Terry. How are you guys doing?
Doing great, Sherry. How about yourself?
Yeah, this week the market has been volatile with Fed decisions, Powell speech, and a lot of data points. So there's a lot of things to chat with you guys today. So first, maybe we talk about the data coming this morning, 8:30. The job report coming cooler than expected, and market have a reaction to that. So do you guys think it will increase the odds of recession?
You want to take this first, Jay?
Sure, I'll kick it off. So we've gone through the report pretty closely and obviously underperformed expectations. There's some prior revisions as well to the June and May data that added to the weakness. The hourly earnings came in a little bit softer, so that all points to inflation cooling off as growth slows here. Now, I think it's important to note that this wasn't necessarily a fall off the cliff type report. It was certainly a slowdown from the numbers that we've been seeing, which was really inevitable. But a closer dive into it, and the figures weren't particularly bad. Headline numbers will definitely stick out with that unemployment number jumping to 4.3 from 4.1. And we actually saw Chicago Fed President Austin Goolsbee touch upon that in a Bloomberg interview just about an hour ago. But I don't think that these are quite recessionary numbers at the moment. They're trending in that direction, and I think that's what the market is concerned about. And there was just a hypersensitivity towards growth concerns going into that number, which I think is why you're seeing such a negative reaction. But as the Fed says, they don't want to just get stuck on one data point, nor do us as market participants want to. It was weaker data, but I don't think it's pointing towards a recession at the moment. Terry, I don't know what your interpretation was, but I'd be curious to hear.
Hey, so I think that when you look at race cars that race on a muddy track with off-road tires, they have to start turning way before the track curve hits, or they go smashing into the wall. And that's like monetary policymakers trying to manage a soft landing situation. And to me, the track is curving, and we haven't turned the steering wheel at all. So I think the market is seeing the soft landing scenario disappear right now. I know that the numbers right now, this time, aren't that bad, but you pair this with construction spending slowing way down, some manufacturing under 47 now and underperforming, and we're up 0.6% off the cycle lows in unemployment. That's a visible inflection on the unemployment rate chart. And if you go back historically, when you get an inflection this large, it's almost never not the beginning of a complete inflection where you end up with 6% unemployment or something higher than that. And especially when I think really the problem for the market right now is rates are extremely restrictive. We should not be anywhere near 5.5% right now, given everything that we're seeing and in the relative trajectory of rates over the last decade, where we are right now and where inflation is right now and what we're starting to see with that track curving. It just suggests the Fed needs to, I said this to you in a conversation we had yesterday. I think they need to do an emergency intermeeting cut of 50 basis points and then maybe cut again 50 more basis points at the September meeting. And that's the only way that they're going to catch up. But right now, the market is saying they're behind the curve.
Got it. And now maybe we look at the market today. So the S&P 500 is set for the worst day in 2 years. Do you guys think we are in the bear market territory now, or it's just a correction?
I can start with this one, Jay. So I would say, no, we're not in the bear market. We're the bull market. And usually when you get a cycle turn in terms of the business cycle, then you get that moment, that come to Jesus moment for the Fed, when they start to realize they're behind the curve and they start to get aggressive with rate cuts. Almost always there's a higher high in the market. Stocks, and if you look at a good example is if you look at 2007 in August, the Fed did an intermediate cut. I think it was 75 basis points. And we started to see the off-balance sheet vehicles for some of these funds with mortgage-backed securities just blow up. So they did the 75 basis point cut, and we just ramped to new all-time highs. And that was before the 2008 crash. So that cycle was a much worse situation than we're facing now. Now is a much more garden variety, inventory to sales ratio kind of issue that's going to come into play based on monetary policy being held too restrictive for too long as the generals were fighting the last war. But I think that when you do get that inflection, when market senses that there is a new sense of urgency in the Fed, and they realize that being at an average of 538 basis points on rates on the policy side is just outlandish, and really they need to be somewhere around 3.5% or lower. Just look at where the 2-year is now. The difference is ridiculous historically. So they're just way behind the curve. And if the market sees that they're starting to take that seriously, and there's going to be a complete paradigm shift in how it's being handled at the Fed, then inevitably, I think that there's going to be just a money pouring back into the stock market on the hopes that they've managed to right the course. Again, most of the money being managed right now in stocks, it goes to the winners. And the winners over the last year and a half have been people who are willing to just nakedly buy into dips. So they're controlling the vast majority of capital that's in the managed money side in the market right now. And that's where it goes. It goes to people who've been winning, and the only way to have been winning is to nakedly buy into dips. So that's where capital is being held. So that instinct is going to be there, and we always see this overshooting to the bull market when the cycle turns. So I would say, I don't think this is a bear market yet. I think that it's the possibility for it to develop into one, possibly early next year, but we'll see.
I would agree with pretty much everything Terry said there. Now, there's a few things that I just don't see coming. An emergency Fed cut would be one of them. One of the reasons why I think Powell didn't go as dovish as he could have on Wednesday was just because they know they got Jackson Hole in the backdrop there, where they could kind of rearrange the message. We started seeing a little bit of that today with Goolsbee coming out, talking about the unemployment rate getting above 4.1%, which could spur the Fed into action, was what he was saying. They continue to talk about inflation coming down in line with their expectations. Now we're just taking a look ahead at the next big data point. That's not until the CPE number comes out, which I believe is around August 13th or so. In a week, there's not a ton of data coming out. There are going to be 3 big bond auctions going on, though, and one gets the sense that they're going to be really strong bond auctions. Number one, from a standpoint of safe haven buying. Number two, from the idea that if there is the expectations that rates are going to come down in the next coming weeks, they're probably going to want to send in this paper, which is going to have a higher coupon. So there are a few things that could come into play that could stave off some of the immediate selling pressure that we're seeing, in terms of where we stand if this is a bear market. I agree with you. I don't think that we're in a bear market yet. There is some seasonality that comes into play in September and October that could win on things, or we could be seeing that getting pulled forward just a little bit in front of the election. So that's going to be something that we'll be watching closely. Week there's a slew of earnings, a lot of them consumer oriented type, like the Ubers and Lyfts of the world. So it's going to be interesting to hear what they have to say. Ralph Lauren, a high-end retailer, is another name that we'll be watching just to see the strength of the consumer, which does make up about 68% of the economy here in the U.S. So they're going to be all that we're going to be watching for a recession. But I think it's going to be tough for us to fall into that recession with the idea of, 50 now coming in September, getting factored in. Not a lot of people are going to want to leave the party too early on that. So you watch on data play out closely here, but there's just really no evidence at the moment of a recession that's imminent. Now, again, we are trending towards weaker growth, that's for sure. But we will continue to follow the data on a point-by-point basis, much like the Fed is. Terry, I think you got a follow-up here.
Yeah, the biggest tell for people listening at home, if you want to see the market's real-time opinion, whether or not this is going to turn and melt into a recession and a bear market, the earliest tell is going to be credit spreads. If the Fed starts to talk about a 50 basis point cut in September, which is what the Fed funds futures now are pricing in, it's already there. It's 50 basis points in September as of this morning. I think this is less.
Yes.
Will bring us to, percent. Going to do anything for a weakening economy. Like, they need to get down to, if this is a recession, they're going to be at 2%, at a time this is all said and done. So we're talking about some drastic shift in the way that they're looking at this situation if we are turning that way. Maybe we're not. Maybe this is just a one-off, not so great number. Maybe things are just softening and we're not inflecting. But my suspicion is we're inflecting just because rates are where they are, and that has a dampening effect. But let's say we're not. You're going to see that by credit spreads staying relatively tight, which basically means corporate bonds aren't going to diverge very much from treasuries. If we start to see the opposite, if you see junk bonds just melt down in the middle of this, and even triple bonds turning and you run those bonds just diverging wildly from interest rates at the treasury, that's going to tell you, that's a real-time market clue that this is an inflection, not just a period of softening. So that's probably the most important thing to be watching closely.
Yeah, and just to add on to what Terry had to say, not only did we see the September Fed funds rate cool off or jump up there in terms of expectations of a cut, but for the year, they're now pricing in about 1.15% of a rate cut. So that'll be 4 to 5 cuts that they're looking at through December. So right. Now the Fed funds futures have tended to run a little bit more dovish. If we recall, at the beginning of the year, they were pricing in 6 rate cuts that slowly whittled down. Now we're seeing that edge back up. So there is the element that the market's a little bit addicted to those low rates, and they operate. A lot of people here that are now managing money, market 12 years ago, they're used to these 0% levels for operating in. So there is going to be a bit of growing pains moving to some of the higher end rates. I mean, historically, a high rate right now, but factor in across the board, people looking for those lower rates, but following the markets, the HG and J and K ETFs, they follow those high yield ETFs and the junk bond ETFs. They're 2 areas that you should have up on your charts just on a daily basis.
And compared to TLT. So it's really the comparison.
Yeah. That's
so HYG and the TLT should be
J and K.
Yeah, that'll give you a basic idea of the difference. If TLT is really strong and JNK is weak, you know that it's diverging wildly. And that's exactly what we see today.
That's how you can follow from home if you don't have access to the credit default swap spreads.
TL is soaring these 2 days from.
That's an yield. So with yields crashing down below 4%, TLT, the bond's going to fly on that. All the bond ETFs will rally on that.
Yeah. So looking at the market, maybe we took a look at some individuals like the Magnificent Seven. So yesterday, Apple and its earnings, and today Apple is up. I think Amazon is down like initially it's 9%. I think surprised at Amazon because I saw it has a mixed earnings. So what's your Amazon stock? Whether the fundamental has changed based on these earnings?
I could the Amazon. So overall decent quarter. They had a small top and bottom line beat. They beat on their AWS cloud revenue numbers. So they beat on their advertising revenue as well, following Meta Platforms, who also beat on their ad figures. This followed a miss by Alphabet. So those 2 seem to be taking a little bit of a lead. So that's notable. Amazon net outlook came in at about 14.4 billion, I think, and their guidance had been for 10 to 14 billion. So the numbers for the quarter were fine. Their outlook was conservative, and we talked about that at the beginning of earnings season, where there's not much companies to stick their neck out, so they're going to put out conservative figures for the upcoming Q3. There's a lot of uncertainty out there in the markets, and that's evident in the guidance. We're a little bit lighter now. On that front for their Q3, I think people were concerned about for Amazon in particular was their comments around the rise in competition from Temu and Shine, which were really impact. Jeff Bezos is on the phrase "buy opportunity," right? So he's kind of getting a little bit on that from some of these Chinese companies, and that was reflected in the stock. But we are seeing it come into some interesting support level here at the 200-day moving average. Terry, I don't know if you got a chart in front of you, but I'd be curious at hearing your thoughts on that.
Yeah, so they got a gap fill right along, this area roughly.
What the 200-day moving average too?
Yeah, so back about that would be good. But you see the range that we have we've constructed since probably on earnings in early February. But you do have a kind of expanding megaphone pattern there that is awfully bad looking. Since February, data bar hits today. You've got this popping pattern, which is not pretty, generally speaking. Also, didn't we hear that they got some like their agenda and a half is like a lot of infrastructures, and that's like their margins are going to get sunk.
Yeah, well, that's one of the things we've seen from a lot of these mega cap names. Started with Alphabet,
Right.
Meta Forms, they raised low end their outlook. Microsoft's expense numbers were up 77% year over year. It's the cost of doing business, right, Terry?
Yeah.
Where they've got as many NVIDIA chips as they can. All these numbers are great for NVIDIA and AMD, by the way.
Right.
And the storage stocks like Seagate, Micron, and Western Digital. And it was real interesting to see those names kind of roll over despite good numbers and decent outlooks. But, this all raising around these Magnificent Seven names. They're spending all this money. What's the ROI, the return on investment in it? And, it's quite frankly part of the build out, the growing pains, if you will, of the AI industry, which are inevitable in any industry expansion. Just right now, it's fallen in on sentiment for these stocks.
Yeah, and I think the question is, you look 5 to 10 years down the road. I mean, if we're talking about at some level, and if you look road, like, or there's to start to take some of the profits away, which sinks that return on, because you end up with so many dispersion of jobs in the real economy, basically with people being displaced. Intelligence.
Yeah, and another stock has yesterday is Apple. Apple stock.
Yeah, Apple, a great one. I mean, Sherry, I know the app in front of you, and that green apple's just screaming out there. Just kind of highlights the price action that we're seeing. All the AMD, they're benefiting off Intel horrible numbers there. A lot of people see AMD is grabbing share, but Apple's just a shining beacon in that heat map. All the rest are pretty much safe haven plays, right? Your PGs, KOs, Pepsis of the world. So just look at that. They had a good quarter. They basically beat across the board. Now, we started talking about this at the beginning of the earnings season, where a lot of these analysts hadn't really reined in their expectations for this quarter. And they were 9% EPS growth for the S&P 500, primarily in the Mag 7 there. But that was one of the numbers that we'd had, I think, since Q2 of 2022, I believe it was, which had some easy comps against some COVID figures. So tremendous growth, and but they're not blowing it away. Usually, on average, you see 3 to 4% beats on the bottom line from companies. It's a lot lower this time around because of that higher bar and the lack of revision. And Apple kind of falls into that realm there, where they've just slightly beat pretty much on every metric. The miss in Greater China revs was probably the one glaring aspect there. But we know China's been running a little weaker on the economic growth for the last couple of months now, last couple of years, really, at this point. But Apple was just able to, and now they're doing dividends, so that it's turning into more of an income play. And I think people just kind of really see this place to park money, and that's why you're seeing the outperformance in it. Terry, I'd be curious to hear your take on the price action in Apple today.
Well, I mean, it's all that the stocks dominating our stock started really the primary domination during a period of very low interest rates and during a period of economic uncertainty, because they've got tons of cash and they're going to grow no matter what the economic environment is like, because of their their new kind of industries and impacts. So there's a future for them. 7, it's pretty much defined by that idea that they've got the first mover status and the front pole position in terms of dominating the industries that are in the economy 10 years down the road. And they've got cash and they can buy up anything that comes along. And so, that all for a decade. And so it's no surprise to see, who's ever maybe most steady and most dominant kind of respond best when things are starting to fall apart.
Got it. So Jay just mentioned that the assets are like moving to the safe haven, like a dividend stock. Would it be a strategy to buy this high dividend stock right now, as Fed is going to cut rate on September? So probably the money from money market fund and the treasury are flowing to those dividend stocks, Coca-Cola, eat like SCHD.
Yeah, I mean, you definitely incentives there. Utilities, they were one of the stronger performers yesterday. Staples as well. So there is that element there. Now, as Terry was talking about, we haven't gotten the rate cuts just yet, but people are starting to look at that, and the money market funds, as attractive as they've been, probably not. So now, obviously, we're not such amount of money flowing into equities, as evident by we're on pace for the NASDAQ since I think it's November of 2022, I believe it was. But they'll start becoming a little more attractive, but they've got their own warts at the moment. You look at Staples, and you got to have some margin concerns, where one of the elements that we've been seeing constantly from the ISM figure is higher input costs, the lower ability to pass on to pass an evidence in the beige book. All points to margin compression, and when you're running a company that's on pretty tight margins, such as Staples or something like that, it's not necessarily that you run to in this scenario. So they will be seeing that money flow yet. Terry, you got any thoughts on that?
Yeah, I mean, so we've got across the curve 4%, etc. And the yield is 1.3%. So this is a different world than we lived in, let's say, 6, 7, 8 years ago, when the S&P dividend yield was constantly above the U.S. 5-year, 10-year. That's a very diverse. And if we're to say where spreads do start to widen, then the next thing that's going to happen is dividends are going to start getting cut. So I think you're in a situation, money that would be thinking along the lines of 10 years ago, seeking protection in dividend stocks, is just going to be buying treasuries.
Got it. And last question, but not least, as we also see some chip companies report earnings week, AMD, Intel, and also ARM. What do you think about the semi sector? Do you feel like it's a correction territory and the going lower next week?
I mean, I would say this is a trend, and so every dip should be bought, but they obviously are going to be volatile, and you really need to. It's a difficult space to play, because I think I like to position stop loss orders, and I think that's one where you're counting on a secular trend, so you need to be careful about maybe dollar cost averaging it up. What do you think, Terry or Jay?
Yeah, it's an interesting one. Fundamentals haven't been, this price performance has been. We mentioned briefly this earlier, Micron, Seagate, Western Digital, and they all had pretty good quarters, but the price action certainly isn't pretty there. And what you generally get for chips is the rule of thumb is buy chips 6 months before, or you want to sell chips 6 months ahead of and buy them 6 months ahead of the peak, right? So that means you're basically kind of selling during good news, given the cyclicality around these. And there's definitely hints at the beginning that people are looking at a slowdown coming. Terry was talking about half of 2025. Does that start coming into play? And, that's going to be being forward if we continue to see economic data falling off. Now, this cycle's a little bit different because you got that AI build out and the HBMs, with modules that are performing so well for a lot of these storage plays. When does down is the question. And if that starts slowing down, economic growth starts slowing, start going into the recession, then you should continue to see the cyclical, these chip plays. But I'm not quite ready to fork in them yet. Some of the price action that we've seen is certainly concerning. However, we haven't really seen any cracks in the fundamentals. Just kind of keeps me a little. This is the end of the bull cycle in the semis. So it's a story that we'll see play out in the next month or two it's one that we'll be following really closely. NVIDIA, they'll be reporting of the month, so that's going to certainly garner plenty of attention. But I'm not quite ready to say that the semiconductors are done yet, but there's certainly been cracks in the armor over the last 2-3 weeks.
Yeah. I also feel like it's interesting to because that NVIDIA chart, they have this up pattern, and they going down, and seems that it has had the bottom 101. And also recently, Nancy Pelosi also bought the dip. So I just feel like very volatile. It feels like pennies now. I think option players, especially ZTE options, and it makes the price. It feels like even more volatile than Bitcoin nowadays.
Yeah, a lot of speculative money flowing.
A lot of that to do with pickup of retail options trading too. I feel where you just have more and more people leveraged up on these options that create a lot more volatility.
Yeah. Okay, I think that's our conversation today. So today we talk about the macro, the data coming this week, Fed's decisions, the rate in September, well as the tech earnings and also semiconductors. And I think we've learned a lot from the conversation. So thank you guys, Jay and Terry, and look forward to more earnings next week and the conversation then.
You got it, Sherry. Thanks.
Thanks a lot, Sherry. Everyone have a great weekend.
All right, take care, Jay.